Wake up to a notification. Your savings earned $3 in interest. Your money is literally sleeping. My name is Nova, and I spend way too much time thinking about how to make my money work for me. If you're tired of watching your savings sit on a checking account, hit subscribe and give this video a thumbs up if this helps you out. First, let's talk about the difference between a checking and a savings account. A high-yield savings account is just a savings account, but with a higher interest rate. Why does interest matter? It's the invisible engine that turns your dollars into more dollars. In 2024, the average high-yield rate was around 3.5%, compared to about 0.05% for most checking accounts. Interest compounds daily, but the effect compounds over time. Every day, it adds to the next day's base. Let's do a quick math. $5,000 at 3.5% for 1 year gives about $176 in interest, all on top of your principal. And this money is FDIC insured up to $250,000 per depositor per bank, so you're safe, even if the bank faces trouble. Online banks often offer higher rates because they save on brick-and-mortar costs. To find a good rate, check comparison sites like Bankrate or NerdWallet, then look for the latest offers. Myth: high yield means you'll lose your money in a downturn. That's false. FDIC insurance covers it. Watch out for hidden fees. Some banks charge a monthly fee if you don't maintain a minimum balance. The minimum balance can vary from $500 up to $10,000, depending on the bank's policy. Interest is typically credited monthly, but some accounts give daily compounding and add it each day. If you keep $5,000 for a year at 3.5%, you'll earn roughly $176, more than a typical credit card reward program would give you in the same time. Now set up automatic transfers. Schedule a weekly or monthly move from checking to savings so you never forget. Treat the savings account like an emergency fund. No withdrawals until you hit a genuine crisis. But you can also use it for short-term goals: a vacation, a new gadget, or a future car deposit. Psychologically, seeing your money grow every month keeps you motivated. Those little bumps are a visual win. Here's what most people don't realize. Setting up automatic transfers turns saving into a habit, not a chore. You can schedule transfers on the same day each month, so the process feels natural, just like paying rent or bills. Compare high yield with your regular savings. The difference can double your earnings over 10 years. To pick the right bank, look beyond rates. Consider customer service, app usability, and fees. Your credit score can affect which accounts you qualify for. Some banks only offer higher rates to excellent credit holders. Security isn't just about FDIC. It's about encryption, two-factor authentication, and regular monitoring. Most high-yield banks have slick mobile apps. Check balances, set alerts, transfer instantly, right from your phone. Don't forget to set up alerts, so you're notified when you hit a new balance milestone, or when interest is posted. Let's do a real-world example. $10,000 at 3.5% yields, about $350 in interest after 1 year. That's almost $30 a month, all without extra effort. Just passive income from your own money. Project that over 5 years, your $10,000 could grow to roughly $13,000, $3,000 more than you'd earn in a checking account. If you withdraw, you still keep the earned interest, but you lose the compounding effect for future periods. And remember, most high-yield accounts have no penalties for early withdrawal, but frequent trips can erode compounding. Avoid ATM fees by using the bank's own network. Most online banks give you free nationwide ATM access. To avoid overdraft, keep a buffer, set up alerts for low balances, and automate transfers when the balance dips. While credit cards offer rewards, they're not the same as earning interest. Spend responsibly, but don't rely on them to grow your money. Interest rates don't keep up with inflation, so your real purchasing power might shrink if rates lag behind inflation. Rates change. Watch the news and stay flexible. If the rate drops, you can move your money to a higher yield account. One trick is to build a savings ladder. Set different accounts with different maturity dates to match future needs. Automate transfers. Set a date each month that sends a portion of your paycheck straight to savings. Set clear goals, whether it's $5,000 for a trip or $20,000 for a down payment. and watch your progress slide upward. Use budgeting apps like Mint or YNAB to track spending, see your savings grow, and stay on target. Set a savings target and celebrate milestones. Every $1,000 is a win that keeps you moving forward. Remember, your checking account is for day-to-day bills, while the high yield is for growth and safety. Most checking accounts have 0% interest, so money really stagnates. Don't let it sit idle. Tax-wise, interest is taxable as ordinary income, so don't forget to set aside a portion for taxes. Unlike capital gains, interest doesn't get special tax treatment, so plan your withdrawals accordingly. The bank will issue a 1099 INT form. Keep that handy for year-end tax filing. If you're pulling money for a large purchase, you can set aside a separate account to avoid dipping into your high-yield funds. Seeing growth visually keeps your mind on the future, so use charts or a simple spreadsheet to track your progress. A simple Google Sheet with date, balance, and interest earned can be your personal growth diary. Use a budgeting app to set automatic reminders when your balance hits a target. Your brain will celebrate the small wins. Don't let the checkbook mental account entrap you. Your money isn't siloed, it's a pool that grows together. Visualize your money as a plant. Water it with regular deposits and watch it grow tall and fruitful. Use a spreadsheet to forecast. Input your monthly deposit, rate, and see future balance projections. Add a row for annual interest, then let the spreadsheet do the rest. No manual calculations needed. If you're not tech-savvy, even a paper notebook can work. Just jot down each month's balance and interest earned. Envelope systems can help. Use a separate envelope for your monthly savings deposit to keep it separate mentally. Lifestyle inflation is when your expenses rise as your income rises. Keep the opposite by not increasing spending when you earn more. Myth: the more you earn, the more you'll automatically save. Reality: you'll just spend the extra and save nothing extra. To keep spending in check, set a monthly budget and stick to it. Your savings account will thank you. A money mindset that values delayed gratification beats instant gratification in the long run. Positive reinforcement: every time you hit a new balance, treat it like a tiny celebration, not a luxury purchase. Use visual reminders. Stick a chart on your fridge that tracks your balance over time. Regularly check for hidden fees, especially if you're using an ATM outside the bank's network. Rate comparison charts help you see which bank offers the best return for your money. Look at the annual percentage yield APY. High-yield rates can jump from 2.5% to 4% in a month. Don't miss the opportunity to switch if it's worth it. Use comparison websites like Bankrate, NerdWallet, or PersonalFinance.com for real-time rate updates. Aggregator tools pull data from multiple banks. Just a few clicks can show you the best rates. Here's the current top rate: 4.5% APY, available at a major online bank with no minimum balance requirement. Locking in a rate is simple. Most online banks offer a fixed rate for a limited period, but you can switch anytime before the term ends. If your rate drops, you'll still have a safety net. The FDIC insurance protects your balance regardless of the rate. Don't panic when rates dip. Just move the money to a higher yield account if the difference justifies the effort. Transferring money between banks is quick. Most use ACH transfers that take 1 business day and cost nothing. Avoid transfer fees by using free ACH instead of wire transfers. Just stick to the same bank or partner banks. When you need cash, use your checking account to avoid withdrawal fees. Most high-yield accounts limit ATM access. Use ACH transfers for moving larger amounts. No hidden fees, just a simple electronic shift of funds. Keep track of all transactions. Most banks give you daily statements in the app for instant review. Set up alerts for any balance change or interest post. Your phone will buzz and you'll see progress in real time. Mobile banking tips: download the app, use two-factor authentication, and keep your password strong. Two-factor authentication is a quick step that adds a second layer of security. Don't skip it. Password hygiene: use a unique, long password for each account and change it regularly to stay ahead of cyber threats. Protect your identity, monitor your credit report quarterly, and set up alerts for any new activity. Avoid phishing. Never click suspicious links. Always verify the sender and the domain before entering details. Set realistic expectations. Interest grows slowly, so be patient and consistent for the best results. Over 5 years, your $5,000 could become $6,500 with a 3.5% rate, enough to fund a car repair or a small trip. Next steps: pick a bank, open an account, set a monthly transfer, and watch your money grow while you sleep. Drop a comment below with your current savings rate or any questions. I'm here to help you find the best deal. Quick recap: higher rates, FDIC safety, automated transfers, and a mindset shift turn passive money into a paycheck. You've got the tools, now it's time to put them to work and let your savings do the heavy lifting. Every dollar you save is a step toward financial freedom. Don't let it sit idle any longer. Remember, the power of compound interest is exponential, so start now, keep adding, and watch the numbers climb. Your money deserves to work for you, so let it sleep at a high-yield account and wake up richer tomorrow. You're the architect of your financial future. Build it, protect it, and grow it with the right tools and mindset. Thanks for watching. Keep learning, keep saving, and keep thriving. Your future self will thank you.